Hi, welcome back to New Venture Creation. Our topic today, we're going to be taking a look at Chapter 13. It's a pretty crucial topic. It's called Where Does the Money Come From? If you think about it, regardless of what type of business you start, you're probably going to need some money to get it started. Even if it's something out of your house or whatever, you probably need at least some funding. And this chapter is going to give you some ideas of where does the money come from. Now, this chapter is divided into three major topics. And the first of them is pretty crucial. How much money do I actually need? Well, if you think about it, if you're trying to figure out where does the money come from, it's probably not a bad idea to figure out how much money do I need. So with regard to that, the textbook says something that's pretty easy, but a lot of us when we start a business don't think about it. Probably the best way to figure out how much money you need is to sit down and just to write a list of all the expected expenses you're going to have. Probably should write down, such things as your rent and utilities. Do you have payroll? How about, let's say, you have equipment that you have to purchase, maybe service. You have inventory. How about marketing and sales and advertising that you're going to have? You might have an attorney and a CPA. What are they going to cost? And certainly, what about insurance? And there's probably a whole host of other expenses you're going to need too. One of my points here, though, is you have to think about it. Now, are you going to get everything right? Are you going to remember everything? No, absolutely not. Nobody, particularly in starting a business, has that good of a crystal ball, knowing what all their expenses are going to be. But if you sit down and you think about it over a period of time, you're going to come up with most of them. And it probably isn't a bad idea to talk to other people who are in business and get an idea, what expenses? These are the list I have. Do you think of anything else, etc., that I have? And you might think about going to, one of the, free public agencies to help small businesses out. The Service Corps Retired Executives Score, which is part of the United States government. Another is the Small Business Development Centers in your area. I know here in Pennsylvania, associated with Penn State, we have something called the Happy Valley Launch Boxes. Go and talk to somebody and get an idea. Search online. What are the typical expenses for you're starting a bowling alley or a pizza shop or whatever it might be, and see what you can find. You probably find quite a lot. And even with all that help, you're still not going to you're still not going to come up with all of them, but you're going to come up with most of them, at least enough to give you a pretty solid grasp on how much do you actually need. I do want to mention one thing too about those expenses. One of the biggest expenses that you potentially could have is rent. I know a lot of people say, "Listen, I'm going to be starting out of my house," or I'm going to have something online, and I'm operating out of my house, and that's fine, and that certainly can keep you away from a rental expense. But there are a couple of things you want to think about with regard to that. One of those is you're eventually going to have to give out an address. You're going to have various government forms you're going to fill out, some of which are publicly available. You're going to be contacting various suppliers that have to deliver something. Your customers are going to be sending you checks or whatever. So you have to give out an address. And the question you have to ask yourself is, do you want to give them your home address? So there at 3 o'clock in the morning, somebody that you're doing business with is knocking on the door because they want to order a new widget, or they're at Sunday morning, you're just getting out of bed and they're knocking at the door and they're saying, "Hey, this thing you sent me, it's the wrong size." So one of the things you might want to keep in mind is, even if you're operating out of your house, you have a website and other things like that. Do you really want to give people your home address? Now, some people solve that by going to the United States Post Office and renting a little post office box. They're not very expensive, and you certainly could do that, but I see at least two problems with that. One, a lot of government agencies that you fill out forms with and get permits and all this other stuff, they actually want a real physical address. They won't accept a U.S. Post Office box. And another, a lot of the customers you have, and give them a business card or something, they look at this thing and say, "Oh, you're located at Post Office Box 102, they recognize right away that you could be a fly-by-night company. You're not really putting much investment into this. So there are a couple of other solutions if indeed you are operating out of your house and you don't want to give out your home address, etc., and wanted something more than a USPO box. One of the things you might think about is I know some businesses, and I'll mention one. I'm not endorsing it. It's just one I happen to know. UPS stores, they're all over the place. Most of those have small post office boxes in them too. But there's a little bit of a difference, and their rental rates are probably a little bit higher than the federal government. I don't know, maybe the same, but it's still really cheap. One of the things I'll mention to you is they allow you to do something that the U.S. Post Office doesn't. The U.S. Post Office, you get Post Office Box 102. That's your address, right? Post Office Box 102, Albuquerque, wherever in your zip code. In a UPS store, from what I've seen, let's say you get Box 102, they allow you to write down Suite 102. So if somebody mails something to the UPS store at 100 Smith Street in Dallas, Texas, or whatever, and they send it to Suite 102, it goes right in your box. There are a couple things for that. People who see that, oh, you're in Suite 102, they don't know it's a little box, so it sounds a little bit more prestigious, and you have a little bit more credibility to it. And also, it's interesting, a lot of government agencies that don't allow you to use a U.S. postal box let you use the UPS box. I haven't quite figured that out yet. Maybe they don't know, but nonetheless, that's a possibility. And again, they don't charge a whole lot for that. Another thought you might have is, I think in an earlier video I mentioned this too, there are a lot of places that offer virtual office suites. Sometimes they call them executive office suites and other things like that. There are a number of names that they use for them. And what they do is they go in and they've rented out half a floor of some building or something like that, and they subdivide that in little offices that they rent out to people. But they also offer as a service to people who don't want to rent an office this virtual office suite idea, which basically says you get to use their office address. The 100 Grant Street, 81st floor, suite 1002 or something like that. As your address, and they allow people not only to mail things to you, which they'll collect for you, but they'll make deliveries and they'll have receptionists gathered, etc. And also, if you have to meet with somebody, a client, customer, some supplier, whatever it might be, you can meet there. Usually, it's a per hour basis or whatever, and rent their conference room per day basis, per hour basis, or whatever. So the person gets off an elevator, walks in, there's this big office, there's usually a secretary and waiting there in a waiting room, hi, Mr. Smith or Ms. Brown or whatever, and they say they want to talk to you, and you're back in the conference room, and they pick up the phone, they call you and tell you, hey, listen, your client's here, and you come out and you meet Mr. Smith or Ms. Brown or whatever, and you walk them right back in the conference room. They think you're renting an office there, when indeed you're not there. Now, these virtual offices, I've seen them rented out for all different prices. I think the lowest I saw at one point was $50, $100 or whatever. I've seen $250, $350 and more. Find something that's inexpensive. A lot of them charge a lot of per diem type things or a la carte type things. Well, if you want to use the photocopier, we're going to charge you $110 per page or something. It's not that bad. But what I would suggest doing is check into them, see if there's one nearby. And I mentioned too in the earlier thing, Regus is in virtually every major city across the world, and there's another thing called Opus, and there's a whole bunch of them. And again, I'm not pushing Regus or Opus, I just happen to know them. Go find it and see what they charge. You might not have any in your location, you might have a bunch. Go see, and it gives you an idea. At least that way, you can still work out of your house. You can still, have your internet site and that's all or whatever. But you have an address that if people come and knock on the door, they're not knocking at your door, 3 o'clock on, Monday morning or something like that. So again, the first thing you want to do is let's figure out how much money I need. Let's go through and let's make that expense list. That's the first major topic. Let's take a look at the second major topic. It involves a buzzword. I mentioned in this class we have lots and lots of buzzwords or whatever, and we're going to involve one here. This is called the next major topic, understanding burn. Understanding burn, and burn's the buzzword, etc. And you know, okay, I know how to burn leaves in the backyard, and I know how to burn wood in the fireplace or whatever. What do you mean burn when we're talking about money and business, etc.? I have four buzzwords, buzz terms, or whatever I want to talk to you about here. First is burn. What is it? Your textbook defines burn as negative cash flow. Negative cash flow. It's cash going out the door, right? Cash going out the door. It's basically, you're burning cash. I started my business and I have $500 in my pocket, and okay, to start this business, I had to give $20 to this person to buy paper and another $100 to that person for this and that or whatever. All this cash is going away. It's basically I'm burning through the cash. That's burn. Now another buzzword, the second one I have for you is called burn rate. Burn rate. This is how fast or how slow are you burning through your cash. The rate of burn. How quickly am I going through this? What's my negative cash flow, so to speak, that I have? And if you think about it, whatever cushion or whatever you have, and I'm going to give you a buzzword for that in a little bit. Your burn rate is going to impact how much money I have sitting in the bank that I have. So it's usually a good idea, if you can, depending on the business situation, to have a lower burn rate than a higher one. Because a higher burn rate, you're burning through cash faster than a lower burn rate that you have. The next buzzword I have for you, buzz phrase, is one you probably heard of. It's called break-even point. Break-even point. A lot of people just refer to it as break-even. A lot of people call it the BE point, B for break-even, etc. Break-even point's pretty easy. That's where the amount of revenue you have is equal to the amount of expenses, and you're breaking even. Oh, you know what? My expenses last month were $10,000, but the revenue I had was $10,000. How much profit I make? Nothing. How much I lose? Nothing. What did I do? I broke even. That's your break-even point. Probably not a bad idea as you're taking a look at all your expenses or whatever to look at them, assuming that you have all of them. Again, do you have a crystal ball to have that? Your expenses will give you an idea of what your break-even point is. Oh, listen, my expenses that I'm estimating are $25,000. What's your break-even point? $25,000. You have to have that much revenue to be able to break even, etc. on that. And the last buzzword I have for you is something that's called runway. Runway. Oh, there we go. Here's another one of your phrases, Fogarty. We're talking about, where does money come from? And you're flying in and out of airports on a runway. No, that's not what we're talking about. A runway is also known as a safety margin. It's also known as your cushion. Some people talk about it as padding that you have. Basically, a runway is, how much time do you have before you're going to run out of money? You start a business, oh, I have $5,000 in the bank. Well, how long until you burn through all the $5,000? Oh, it'll take me 3 months. Well, what's your runway? It's 3 months. How much cushion do you have? It's 3 months. How much padding do you have? It's 3 months. What's your safety margin? It's 3 months. So, or that total amount that you have. So when we're talking about runway, it's that safety zone you have. That again, that cushion, the margin, or whatever that you have. Because when you start, it could be a long time before you actually start getting money in from sales and other sources of income that you have. So it's probably not a bad idea to have, a fairly long runway. I mean, you get to the point, no, you don't want to have it, forever, because you can be using money in other ways, but a fairly long runway. And if you think about it, this concept of runway, as I said a little bit earlier with regard to padding or whatever, is related to your burn rate. If I have a runway that's this long and my burn rate is slow, right? If I have a runway that's this long and my burn rate's fast, so how much runway do I need? Well, it kind of depends on my burn rate, how much cash I have, and how much I'm going to be using, and how quickly I'm going to be using it. But one of the things I highly recommend, have that padding, have that cushion, have that safety zone, have that runway that we're talking about. Well, that takes us to the third and the final major topic in the chapter. Okay, so where does this money come from? I figured out that, my expenses are going to be, 25 grand or whatever for the first year, and I'm probably not going to be starting to make any income, etc., until the second year. So where am I going to get the 25 grand? How am I going to survive that first year? Well, your textbook lists about 4 different sources of cash that you want to take a look at. There's probably more, but I think the 4 are pretty good. The first one involves another buzzword for you, and it's one that you probably have heard. I'm not sure if you know what it means. I certainly will tell you. It's called bootstrapping. Bootstrapping. This is where you use your own money. This is, money coming from the owner, or if there's multiple owners. Oh, I started this business with my brother or my sister or whatever, and there's a couple of us. It's the money coming from all of the owners, etc. This is called bootstrapping. There's some advantages to using your own money. You're in charge of it. You don't have to go beg and plead to a bank or investor. You don't have to sell part of the interest in the business or whatever. But of course, a big disadvantage is it's your money. And not only are you using it for the business, so there it goes, but now you don't have it for your personal expenses. How am I supposed to pay the rent of my apartment? How about my car? Where am I going to get groceries? If you have a family, you have a spouse, you have kids or whatever, how am I going to pay for them? So there's a big disadvantage to using bootstrapping, but frankly, I don't know any business that I've worked on to help start people in businesses or whatever that didn't use bootstrapping. Even ones where, had multi-million dollars going into it, somebody's putting in their own money. That depends on how much, but they're putting in their own money. So bootstrapping is something you see all over. There's some pros, there's some cons. You want to take a look at some of the things that your textbook mentions, but I mentioned a couple, including how it impacts your personal life. Another source, excuse me, another source of money for your business, another source of financing. The author calls it friends, family, and fools. Friends, family, and fools, the FFF. And let's talk about the first two and then show how the word fools come into place. Friends and family. You might find they give you some money. Oh, here, you're starting a business. Yeah, here you go, etc. I had a student years ago who was the brother of a pro football player. And the pro football player was a star at the time, had a ton of money. How some of these stars, they sign up just for showing up. There's, couple $1 million or whatever, and this fellow just gave his little brother quite a lot of money to start a business. Well, that's great. So you might find friends and family that'll give you some money, and that's nice. You might also find that maybe they loan the money to you. Grandma or granddad or whatever has some money saved up, and they loan you. Oh, here's $5,000 or $10,000 to get started, with the expectation you're eventually going to pay it back. They need it for their retirement or whatever, but at least right now they don't need it. Here's some cash. Here, go and get started. So sometimes you see it coming in as a loan, and sometimes you'll see that they'll give you the money, but they expect to have an ownership interest in the business. Oh, here's $5,000, but like 3 shares of stock or something like that. They might want some sort of ownership interest in it. So that's friends and family. And oftentimes you see a lot of small businesses use money from friends and family. But notice that the author doesn't call it just friends and family. He calls it friends, family, and fools. Well, why do you think the author calls your friends and family who give you money or loan you money or use money to buy part of a business are fools? Could it be that they're giving you the money not because you have the world's best business idea or you're the world's best business person? Could it be they're giving the money to you just because they like you, they trust you, etc.? And that's wonderful. I'm glad that they're doing that. But could it be foolish too? I mean, you might be the world's best person, the nicest person around, but maybe you know nothing about business. Maybe the idea you have is awful. Oftentimes they don't look at that. They just look at you. You're a nice person. I've grown up with you. You're my nephew, my niece. Here, let me help you out. And that's wonderful. But are they investing their money wisely or foolishly? So again, friends, family, and fools. That's another source. The third source, I mentioned there's going to be 4. The third source is called debt financing. Debt financing. Basically, you're getting a loan. You might go to a bank and borrow some money. There's other places to borrow money from too. Again, friends and family might lend you money. You might find some government agencies, etc., will loan you money. So there's different parties. Normally, again, banks, but there's different parties who might lend you money. And usually the expectation is, I'm going to lend you money. There's some term. Okay, here's $100,000. It's a 3-year loan. We expect you to pay it back in 3 years, or maybe monthly payments or something like that. So you have to pay it back. And oftentimes, on top of that, sometimes, in fact, maybe most times, they want you to pay them interest. Hey, if you're using mine with money and I don't have it in a bank account, I don't have it in stocks or whatever, I'm losing out on that income I would have had, I'd like you to pay for that lost income. So I'm going to charge you to use my money. I'm going to charge you an interest rate. Now, sometimes the interest rates are really high, sometimes they're really low. And just to give you an example, we'll talk about this a little bit later. Sometimes, government agencies that are trying to develop an area, maybe there's an area where high unemployment and the business base is going down, tax base is going down. They might loan you money, well below the market rate because they want you to put a business there. They want to help you. They're not going to let you do it for free. They're not going to give you the money. They'll lend it to you, but they'll lend it to you at a low rate of interest. So again, you have this thing called debt financing. Now, related to that, sometimes, not always, but probably more often than not, particularly if you're using a bank, you'll find that they'll lend you money, but they want you to put up some collateral. They want you to give them what's called a security interest. And what I mean by that is, okay, you borrow $100,000 over 3 years and you don't pay it back. Okay, the bank is sitting there saying, "Oh my gosh, we've lost $300,000 or $100,000 over that time period." Well, usually what the bank will do is they'll make you put up something like your house and maybe other things like that as collateral. And that's called, by the way, when you do that, the collateral, there's a buzzword for it. It's called a security interest. A security interest. The bank has an interest in the collateral. And if you don't pay, we're going to go out and seize the collateral and do other things. And why do we have the word security and security interest or secured loan and other things like that? Well, think about it. If a bank is lending you money and you put up your house and you don't pay back the loan and they go out and they seize the house, the odds are they're going to get the money back that they lent you. So it's somewhat of a secured loan, right? The odds are I'm getting my money back. So this is called a secured loan, this interest that you give the bank. They don't own your house. It's collateral, which means if you don't pay, they go and they seize it. So it's called a security interest. So you might want to take a look at some of the buzzwords and phrases that are mentioned in your book with regard to this concept of debt financing. The last type of financing that I'll talk about here is called equity financing. Equity financing. There's a couple of different ways to equity finance, get equity finance. Let me first tell you what it is. There's a buzzword for you, equity financing. What is it? Equity financing is where you sell off a portion of your ownership interest in the business to somebody else. They give you money for it. Oh, here's 10 shares of stock in my company. Here's 10% of my company, etc. You sell it to them. They give you money. They make an investment. So what we see here is when you sell off this portion of a security and of an ownership interest in your business, there's another buzzword for it. It's kind of confusing. This oftentimes share a stock, but you can have partnership interests and other things that you sell them as ownership interests, etc. This is known as a security. Notice a minute ago or so when we were talking about debt financing, we talked about a security interest. And now I'm talking about a security. Don't they sound the same? Completely different. One of those things that law just does, has all these buzzwords and phrases that don't make any sense. Don't get confused. Again, the concept of a security interest is that collateral you put up for a loan. So security interest is related to debt financing. A security, on the other hand, is something that represents that ownership interest you sold to an investor. A great example of it, not the only example, but a great example is, oh, I sold you that, and I gave you some shares of stock. The shares of stock are known as a security. Now, related to that, One of the big problems of selling a security to somebody is the offering and or sale of securities is regulated, highly regulated, by federal and state law. There are federal securities laws, and virtually every state has securities laws, etc. And the regulations are pretty intense. And if you violate them, oh my gosh, literally in some cases you could go to jail, like securities fraud and things like that. So and there are exemptions that say, you know what, in your case you're okay, don't worry about the law and you're exempted or whatever. But my recommendation is if you do think about raising money for your business, getting money for your business by selling securities, or at least offering to sell securities to somebody, you might want to talk to an attorney, and particularly one who has some knowledge of securities laws, etc., just to make sure that you've dotted the I's, crossed the T's. If there's papers to file, you file them. If you're exempt, and you know it, etc. Just be careful. You don't want to have your state securities commission or the Federal Securities and Exchange Commission knocking on your door one day and saying, hey, we think you violated our law. So be very careful about that. Examples, too, of people you sell securities to, besides friends and family and, might sell publicly, publicly traded companies, etc., that you have. There's one or two others that I want to mention to you. One you probably have seen a lot. Have you ever watched Shark Tank, that TV show? The sharks are basically investors in a business, right? Most of these businesses you see, oh, come on, I'll sell you a third of my business if you give me $100,000 or something like that. What are they doing? They're selling an ownership interest in their business in exchange for your investment, the money they're going to use to run the business. They're selling securities to you, or at least offering it to you. Maybe you accept or don't. Sometimes the sharks say no or whatever. So when you see the sharks, that's a type of security financing. And sharks are known as angel investors. There we go, from a shark to an angel. Don't you see, angels writing on the back of every shark out there? Angel investors are usually the first round of investment. After you've done your pocket and the friends and the family and you borrowed money from a bank or whatever, if you still need money and most of these businesses you see on Shark Tank, they've started and they've made some sales or whatever. Now they want to grow to the next step, the first really big step. They don't have enough money. They don't have enough money coming in from sales. They don't have enough money in their pocket. They go to the sharks, etc. They go to the angel investors. Hey, will you give us that? And that's usually the first round of funding, again, outside of your own pocket and the banks or whatever that you have. After that, and you don't see this on Shark Tank, but after that, after the sharks invest in the company or whatever, and look at how much the sharks are investing. Usually $100,000, maybe a little less, sometimes a couple hundred, sometimes they get up to the million range, maybe a little over that. But sometimes companies, as they get that, they start to grow. All of a sudden, wow, look at this. And instead of needing $1 million or $2 million or even $5 million, they need $50 million. They need $100 million. They are growing like you can't believe. The next round of funding that you have is you would go to what are called, another buzz phrase for you, venture capital or venture capitalists. They're also known as VCs for VC, venture capital, etc. These are investors who will give usually a lot more money than you see on the sharks. And once again, they want a security interest. I mean, a security. They want you to sell stock and other things like that in their business. But it's interesting. VCs are oftentimes referred to not just as venture capitalists, but they say the V stands for vulture capitalists, because they want so much money from you. If you think about it, you go and you put your money in a bank account. You're hoping to get 1 to 3% interest. You invest in the stock market. You're delighted at the end of the year if you made 5 to 10%. Well, VCs usually look for 30, 50, 100%, 200% return, etc. They're out for money. But they can be quite helpful, just like the sharks. They have contacts, etc., and they have the money that you need. But you want to be careful about that. Related to this, though, there's kind of maybe something in between, because I want to talk about one other type of equity financing. There are times when you start a business, there may be a business that's already established, oftentimes a corporation, but it doesn't have to be, already established, and they want to start this business. You're not going to be in competition. You're going to help them. You're going to supply them with something. They want you to start the business, and they recognize you don't have all the money that you're going to need, etc. And sometimes they will invest in you. A good example I can give to you is years ago, I was talking to one of the big automakers in the United States. And one of the things that they did, all automakers do, they make hubcaps. They make 5,000 parts to a car or whatever, but they make hubcaps. And the way they made hubcaps or make hubcaps is they buy these steel bars from steel companies or whatever, and they're long and thin, etc. And then they bring in the bar and they have this machine, a shear, that just chops the bars up into little pieces. And then they take the little piece and they put it in what's called a forge press, and this big thing comes down and smashes it, and it's smashed into a mold, and out comes your hubcap. So I'd actually talked to one of the large automakers. They were tired of the shearing operation. The machines were old, it was very costly, etc. And they were looking for a company to come in and to shear all their steel that they had. And they were going to help me invest and get the money to buy the equipment and the manufacturing facility or cutting facility, etc., like that. And they would have taken, a portion of the business. There's an example. Sometimes you might find, they call it a corporate partner, but it easily could be a shareholder or something like that. Well, still in this concept of equity financing, there's another buzzword or buzz phrase that I have for you here, and it's one you might have heard of, you might not know what it means, called crowdfunding. Crowdfunding. It's been around for, 10 years, 15, 20 years or something like that, but it's still kind of a new term. And examples of crowdfunding websites, there's a bunch of them out there now, but Kickstarter, Indiegogo, some people say GoFundMe accounts are kind of like crowdfunding. And what you do at crowdfunding is you have this idea, I want to do it, and you need money, and you put it on this website, Kickstarter, GoFundMe, whatever it is. I want to do this, and I need, $10,000 or whatever. And then maybe, the 100 million people looking at the web or something on any given evening might come to your website and say, that sounds good. So, you need 20,000, and you might get, 50,000 people giving you a couple of bucks or whatever, and hopefully it all adds up, or, maybe giving a couple of quarters or something, and maybe it all adds up to at least the 20,000 you have. And sometimes you give them a share of stock or something, an ownership interest. Sometimes it's a sale of security. Sometimes they're just happy to kind of give it to you. Sometimes they want something in return. You're a shirt company. Send me a couple of free shirts or something like that. So you might have to think about securities laws in this, but I can't say, at least what little I know about securities laws, they have been restructured over the last number of years to allow for crowdfunding. Yes, they have their rules and regulations, etc., but crowdfunding is allowed. So that's a source of funding for you if you're looking for some help. You usually find lots of little investors giving you something, but sometimes that money ends up. The only other thing I want to say, and I'm going to close out with this, and I kind of indicated this before, you probably can find that if you're starting something where you're going to be hiring some people, and you're going to be locating your business in an economically depressed area where unemployment's high or whatever, you might find some government assistance. Now, sometimes they'll give you a grant, or they just give you the money, hey, go start this, or at least part of the money, go start this. Oftentimes, they might give you a low-interest loan. I used to work for a organization in the state of Pennsylvania called the Pennsylvania Industrial Development Authority. Pennsylvania Industrial Development Authority. And, government loves to make these abbreviations, these acronyms. So they took the first letter from each of those, PIDA, Pennsylvania Industrial Development Authority, and they called it PIDA. And what PIDA would do is, if you came to us and you said, hey, listen, we're going to put this manufacturing plant or whatever, we're going to put it in some area, whether it's a rural or urban area where there's lots of unemployment, etc., and the economy's bad, etc., the state would loan you money through PIDA. Maybe the market rate was 10%, and they'd loan you the money for 1 to 3% or something like that. it's still interest, you still owe it, etc. But it's a hell of a lot less. And they're doing this to try to help you out to make sure that you get started, start hiring some of these, people in the community, to help out the economic development of the area. Now, related to that, there's another buzzword, though, that you might have heard. And I just want to make sure you know what it means. You might have heard of something called a loan guarantee. A loan guarantee. The federal government, the Small Business Administration, was really big in providing what are called loan guarantees. There's some other places too, but let's just stay with the Small Business Administration, the SBA, and the loan guarantees. Let me tell you what a loan guarantee is. Some people think, oh, it's the government's giving me money to go start. No. The government's not giving you a dime. What the government does is you go to a bank to borrow money. You go to Chase, you go to PNC, whoever, to borrow money for this new business you're going to start. And the bank says, oh, we looked at your business plan. It sounds great. It was pie in the sky, though. You've never operated this. We don't know if you're making any money or going to make any money. The risk is too high. We might never see our money. We might not get our loan back from you. So what the government does on some occasions is it'll go in and it'll tell the bank, hey, listen, let's say I was the borrower. If Fogarty doesn't pay back this $100,000 loan, we'll guarantee it, the federal government or whoever will guarantee it, and we'll pay it back. Well, in that case, the bank recognizes, hey, the risk of this is now much lower because we didn't know Fogarty could pay it back, but we know the federal government can pay it back. So there's a greater reason for the bank to give you a loan. So you might be able to find some sort of loan guarantee. And again, usually it's not that the government's giving you money. It's just they'll give you some papers that you can take to a bank and say, hey, if I don't pay it back, the federal government, the state government, whoever it is, will guarantee it, they'll pay it back. So you might actually want to take a look at that. So that gives you an idea of this concept about money. Where's the money going to come from? How much money do I need, etc. It's not an easy issue. And I want to conclude with just a few remarks about that. Two, I guess. One, if you have a really, really good idea, and you're good at communicating it, and you have a good network to get the word out or whatever, if you have a really good idea and you don't have money, but it's a really good idea, money's probably going to find you, at least a little bit of money to help you get this thing going. Can't guarantee it, but oftentimes you see that because, oh my gosh, I never thought of that idea. It's wonderful. I'd like to invest in your business. So hopefully, even if you have a good idea and no money, hopefully if it's that good of an idea, money will come. But there's another thought too I have for you. Even if it's not, it's a good idea, but I can't convince people about it. I don't have that good of a network. You see a lot of people that have really, really good ideas for good opportunities in business that do nothing because I don't have the money. But think about, for example, the case that we studied in class, the Burt's Bees case about Roxanne Quimby. She didn't have any money, and look at that. It turned into, a billion-dollar company or whatever. And she was bouncing around in the back of Bert's pickup truck, selling candles at flea markets, in Maine or whatever. And she had no money, but she was able to take what little money she got from all these little sales of candles at flea markets or whatever, and slowly by slowly build it up. Maybe that could be you. Maybe you don't. Maybe you have a good idea, but you don't have enough money. Well, maybe you want to start small. Maybe if you start small and it is really a good idea, maybe you'll start to make a little money and a little bit more money and a little bit more money, etc. Maybe that's the way to get your business launched. Don't know, but at least a thought for you. Well, I hope you enjoyed the lecture. I hope you learned something from it. If I can be of any assistance to you, let me know. With that said and done, I'm done for the lecture, and I hope you have a good evening coming up. Good night, everybody. Good night, everybody.